Hey, I'm Chris Parris, Chief Investment Officer with Oak Harvest Financial Group here in Houston, Texas. This is our investment team's midweek release when we examine a news item, headline, or news story making the rounds from publicly available sources, and we ask, is this news or is this noise? Before we continue, please take a moment to hit the subscribe button and hit that notification bell so that you will be notified when we upload new content. Listeners, here we go. Last week, the Federal Reserve Committee met and announced changes to its monetary policy last Wednesday. As always, the financial press makes these meetings out to be, and I quote, the most important Fed meeting in years. Well, viewers, this time around, they were probably being truthful. The Federal Reserve has finally decided to take the training wheels off its aggressive COVID-induced monetary policy. As a quick recap of the outcomes of the meeting, first, the Federal Reserve kept short-term interest rates unchanged. And they decided to speed up the pace of the asset purchase tapering as expected. Chairman Powell doubled the tapering speed so that the Fed's purchasing program will now end in March of next year instead of June. This will free up the Fed to start raising rates from the current near zero level starting as early as the early second quarter of next year in 2022. On a more micro level, the Fed's so-called dot plot, which attempts to predict the number and path of future Fed rate hikes, now has the Federal Reserve raising rates 3 times in 2022, up from the barely 1 interest rate rise that was predicted only 8 weeks ago at their September meeting. I remind viewers that historically, the Fed's dot plot, as well as the often quoted number on TV, that's the Fed funds futures market, have little to no predictive forecasting accuracy beyond the 5 to 10 days prior to the existing Federal Reserve meetings. So what does this mean to you, viewers and investors? This means that we recommend that you don't make any investment decisions based on these often quoted data series. We will not be making decisions based on these data sets for our clients. Instead, as we try to do in the past, the team at Oak Harvest will be using existing historic data since this cycle began. With the beginning of the Fed's QE programs, in combination with real-time cues from certain market price indicators such as forward volatility markets and interest rate yield curves, to warn us of changes in economic landscape or upcoming air pockets in the markets. Historically, the markets and economy have experienced bouts of higher short-term volatility as the Federal Reserve has changed path away from an easing policy towards one of tightening monetary policies. However, listeners, during the initial and early tightening process, the markets have still experienced positive annual returns accompanied by this higher realized volatility and fast sector rotations. Viewers, the Fed's move last Wednesday to telegraph its pivot towards a tighter monetary policy is certainly news in investor circles. As we started messaging to clients in early November, expect more news items like this from the Federal Reserve, as well as increased market volatility for the first half of 2022. Give us a call here at Oak Harvest and ask to speak to one of our advisors. Let us help you craft a financial plan that meets your retirement goals and needs first and your greed second. Give us a call here in Houston at 877-896-0040. We're here to help you on your financial journey into and through your retirement years. I'm Chris Parris for Oak Harvest, and have a great week.